The McAlvany Weekly Commentary, covering monetary, economic, and geopolitical news events. Now, here are Kevin Orrick and David McAlvany.
Welcome to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. And today, David, not only do we have an esteemed guest coming on, but we probably ought to discuss an amazing adjustment that most folks who have money in banks ought to know a little bit about.
That's right, Kevin. The fourth quarter of 2007, banks in the United States earned $5.8 billion. Curiously, just in the last few weeks, those earnings have been restated at $646 million.
Oh my gosh.
How do you go from $5.8 billion to $646 million? Talking about bankers who are supposed to add. They're supposed to be able to calculate numbers, and yet they're having a hard time figuring out what they made or didn't make. This is most interesting. And finally, Kevin, we get S&P, and Moody's hasn't thrown their hat in the ring yet, but S&P finally downgrades Lehman Brothers, Merrill, and Morgan Stanley.
Isn't it strange that they waited to do both of these things? The adjustment on the bank earnings down almost 90%, 89%. And then something that we've been talking about for months was the ridiculous high grade of these companies that they're finally downgrading.
So Lehman loses $2 billion last year, raised $4 billion in preferred shares, a preferred share offering, then raised another $2 billion in early May through their 30-year bond offering. Now they're looking at raising an additional $3 to $4 billion to improve capital levels. This is more of the same, and as our listeners know, the bank stocks, the financials have been hurt badly, and they continue to be. Why? Well, they continue to make loans that they shouldn't be making. And we're not talking about just subprime loans. You've got Bank of America and Wachovia. Wachovia being the country's second largest maker of construction loans after Bank of America. There's $24 billion of debt outstanding to developers of single-family homes. $24 billion tied up in projects that are being developed right now. Kevin, where's the appetite for single-family homes? We know where it is. You look at the Case-Shiller Price Index for homes, and in the first quarter of this year, you're down 14%. 14%. Believe it or not, that's a steeper decline than during the Great Depression in the 1930s.
You know, I saw that graph, and it was like I had to look at it 3 times because it looked like there had been an error in the graph. You know, most graphs look sort of like a sawtooth. This thing just looked like it hit a wall and plummeted, and it's greater than the Great Depression. What did it go back to? The 20s? Whatever it was, the graph included the Great Depression, and housing prices fell less at that time than now. And with the drop in housing prices, let's contrast that to what's going on with inflation.
So, Kevin, that may sound deflationary.
Yeah, but
housing prices down 14%.
I'm paying over $4 at the pump right now, and look at the food prices and everything else. It doesn't seem that we have deflation except for maybe in housing prices.
This is the irony, Kevin, and today we're going to spend some time with Russell Napier. Russell Napier is the author of Anatomy of the Bear, a fantastic book. I can't recommend it highly enough. But the concept of inflation that we have discussed most, Kevin, is monetary inflation, where you expand the monetary aggregate, you expand that base, and it shows up in the price of real goods and services. It takes more dollars to buy the same stuff. So a gallon of gas, a loaf of bread, a dozen eggs, those things are costing more dollars, not because their price is going up, but because the value of the dollar is going down. One of the things that Russell will discuss with us today is a new twist on inflation, and it involves China,
which is his area of expertise. In the late 1990s, Russell was ranked #1 for Asian strategy, both by Asia Money and institutional investor polls. And so just mentioning in the Anatomy, the Bear book, sometimes you'll read a book and you realize the author really put in a whole lot more time than you had yourself to do the research. He went back to the Wall Street Journal all the way back to 1896 and studied 70,000 articles to understand bear market bottoms. Remember when we were talking last week about transitions and trends? This man probably has the finest bead on teaching people how to recognize the change from a trend to a transition.
Today, one of the things we're going to look at is inflation, the role that China plays in the current inflationary trend, and what the consequences are of inflation on equities. What does it do to the valuation of equities? Russell, we would love to know what you believe to be the most important factors affecting real rates of return over the next decade.
Over the next decade, the most important thing for everybody to consider is what the future rate of inflation is going to be. I think many people for the past decade and arguably for 2 decades have got used to living in a world where the rate of inflation has been falling. And that's been a benign environment for many financial assets. In fact, most financial assets, because it's a benign environment for both bonds and equities. A period of rising inflation or rising inflationary pressure, both are equally bad for equities. And what I mean by rising inflationary pressure is that inflation which doesn't necessarily get out of hand, i.e. not a rerun of the 1970s, but the inflationary pressure which forces central bankers to run a tighter monetary policy over the next decade than they have done over the past 2 decades, with negative implications for equity valuations and growth. So I think it's a completely different environment. One of the most dangerous things you can do, I believe, for the next decade is to extrapolate the last 2.
So what would cause sort of an upward course of interest rates to become the new established trend?
Yeah, I think a great place for investors is by reading Alan Greenspan's book. The first half is about Alan Greenspan, but the second half focuses on big economic issues for the next 30 years. One thing he focuses on is where the global disinflation has come from. He lays it very clearly at the door of globalization, not central bank policy. He makes it absolutely clear that the central bankers adjusted policy to be commensurate with changing global trends, but they did not bring down inflation. He then says that the powers of globalization will reverse to produce higher levels of inflation. And he particularly focuses on 2 issues on this globalization story. Number one, the flow of workers from the command economy to the market economy globally must come to an end. It is a structural shift. It must slow down. Moving those workers from highly unproductive means of working in the command economy to the market economy has been very disinflationary, particularly the Chinese ones have produced goods for the globally traded goods market. And secondly, and just as importantly, most of these people have not been able to consume the way we consume in the West, because particularly in China, they haven't been facilitated with consumer credit.
Russell, do you see that shift changing at this point? Do you feel that at this point the Chinese are starting to become more and more consumption-based?
Yeah, absolutely. I think we've seen the important inflection point for that just in the last few years. I think the markets have not picked up on it as much as they should have. Everyone's focusing on China driving up commodity prices, but they're not focused on the change to consumption, which really can drive up the price of most everything. And that is, if you go next time you go to a store, look around and see what's made in China, and imagine what would happen that instead of falling in price, which those things have been doing for at least 15 years in the United States, they begin to rise in price for one simple reason, and that is that Chinese people themselves start to buy them. For many decades, Chinese people have not been facilitated to purchase many consumer durables. But if you look back in the history of America, you'll see that the great enfranchisement of the American consumer begins in 1919 with the invention of consumer credit, particularly General Motors Acceptance Corporation, and that creates the consumer society. It's only in the last 2 years, and I think many of your listeners might find this surprising, only in the last 2 years has anybody in China been able to get any credit to buy anything. Remember, they have a command economy banking system which borrows money to lend to state-owned industries. So this is consumer credit coming from an extremely low base. In fact, I think the only 2 economies in the world where consumer credit would be as low as this would be North Korea and Cuba. So that gives you some idea of the spent-up purchasing power in China. Once the Chinese start to consume more normally using credit, then I think we're looking at higher prices. And the important thing is this is not a 2008, 2009, 2010 story. It's really a story which could last decades. If you think how long the march of the consumer has progressed in America, which it's a decades-long story, not a 1 year or 2 year story. So there'll be a business cycle against the background of the structural shift. But it's that key structural shift. Chinese people buying more of the goods they produce, which is going to give us greater inflationary pressure.
Yeah, certainly here in the United States, the pillar of support for our economy is the consumptive habits of a healthy middle class. We're now at 72% of GDP, which is attributable to consumption, and that's been growing steadily since the end of World War II. And as you said, that really got kicked off in 1919 when we didn't have to have the cash in our pockets to buy the goods that we wanted. We could charge it. We could actually borrow funds for those consumptive habits. So what you're seeing is the major shift in terms of an inflationary trend. We've had the privilege in the West, both in Europe and the United States, of buying cheap goods from China.